Okay, so we have to discuss today a new standard, and that is that is IS-20 government grant. Okay, now we have to discuss the standard. So first we have to understand that what does government grant means. Government grant. Government grant is actually the resources given by the government to an entity with condition attached. Okay, so these are actually the resources given by government to an entity with a condition attached. Condition attached. Then we call it grant. Now this will exclude two things. The one is normal trade. We'll explain this. What does it mean? Grant for normal trade. And another one is unvalue government assistance. And we will discuss what does mean by the government assistance, but we are now talking about unvalue government assistance. Now let's elaborate the concept of normal trade when the government when the government normal trade grant for normal trade will be excluded. It means that grant not related to specific condition, okay, but part of regular, as the name indicates, normal, so it will be a regular business operation. That sort of grant will not be included as a government grant. Clear? Now if I give example, let's say let me write here. For example, wait here. Okay. For example, standard tax credits, and that standard tax credit available to all businesses. So this sort of grant will be excluded from the government grant definition. Clear? Okay, now let's talk about the unvalued, another concept that was unvalued government assistance, and that should also be excluded. The unvalued means that there is no value. So for example, let's say the general infrastructure development that benefiting multiple entity, and okay, and this unvalued government assistance, this is actually a help from the government. Definitely it's a government assistance, so it will be help from the government without visible, I will say detectable, whatever the term you want to use, detectable economic value attached. Clear? Let me elaborate with examples so you'll understand in a better way. For example, we will move on with the data sample example, that general infrastructure development, like I could say like building a road that benefits various businesses or entities, but does not have specific economic value attached. So we have discussed the definition of government grant. Let's move on with the example. Different types of, yes, say types or example of grants. The government also give grant for the general research purposes. So we call that research grant. It may also give grant for job creation, that we call job creation subsidy. Clearly, the more other thing like infrastructure development grant. These are different type of grant. They are more like energy efficiency. These are just for you understanding, like some are for education purpose. Now let's move on. We have just to discuss another concept, and that is very is also important, that we call as government assistance, which is different from that of grant. So government assistance is actually the government actions providing economic benefits to a specific entity. Clear? And this will also not include, I'll say exclude, okay, indirect help, like indirect help like infrastructure development, which benefits multi entities. So government assistance is direct benefits with clear value, often linked to specific entities or activities. Clear? For example, we'll say like governments offer tax credits to a company to encourage job creation. So this government offer tax credit will be the government assistance. If you check the definition, it's the direct help right here. This equal direct help with a clear value and link with a specific entity or activity. So this is also linked with the company and the job creation specific activity, and this is the offer, and this is a direct offer with a clear values. Okay, and this if you see here the government action providing economic benefits to a specific entity, so we call that government assistance. Now let's move on. We have to come to the original topic, and this will be before we move on to that topic, we have just to differentiate here what is the difference between government grant and government assistance. So I will just, here you see government grant is grant is actually this for your simplicity I'll say this is a money, or you will say resources given by government to specific entity, And I have given the example like say government gives money to a school for building a new science lab. Okay, so grant is actually a direct grant is like direct gift or support. Okay, now another one is we have the government assistance. So government assistance is government actions providing economic benefits to a specific entity. For example, government upper tax breaks to a company for using eco-friendly practice. So this is the difference between the government grant and assistance. So assistant is you say like that assistant is more general. Clear? Now let's come to the exact point. Now I think we have already understand the concept of what is the difference between grant, what is grant, and what is government assistance. Now let's move on what are actually we have to be concerned regarding paper here. The first thing is recognition criteria. Recognition criteria when you recognize the grant. So we have two options. The first one is the condition compliance, and the second thing is reasonable assurance. Sorry, it's a reasonable assurance. Okay, what does it mean? It means that grant recognize after complying with the condition and reasonable assurance of receipt, then you will recognize that grant. Clear? Okay, and you know the grant should be a match with the expenditure toward which they are intended to contribute and the statement of profit or loss. Clear? Okay, now we have income grant. From here we'll start income grant. And this is a type of grant, it's a type of government grant. And this is provided to an entity with an aim of supporting its financial well-being, or you may say specific financial goal. Okay, now income grant it may be for expenditure subsidy or it may be for non-financial goal. So if here I will write here if the income grant is for expenditure subsidy, which means that this grant is provided to offset specific cost anchored by entity. And another one is income grant for non-financial goals. And you know this is provided, you know, the aim for this is as achieving goals other than direct financial goals, such as job creation. So this is non-financial goal, which or you can may say like community development. Okay, so When the grant is income grant that is for expenditure subsidiary, so match with the related cost. And the grant for, let's say, for research expenses should be matched with the actual research cost. On the other hand, we have income grant for non-financial goals, so match with the cost incurred to achieve the goals. So grant to promote job creation, match with expenses related to creating jobs. Now, let's give me the example that how you do this. Wait a minute. Here, the first one is income grant for expenditure subsidy, and you have to matched with related cost. Clear? For example, I'll give the example. Let me change the color. So, okay, here, this one. For example, this we have a company X, right? And this company is receive a government grant, okay, of let's say $50,000, and this grant is for research and development. Clear? Now, the research and development project anchored cost, let's say, I'll say like 30,000 in eligible cost. Clear? During reporting period. So how you recognize this? How you recognize this? So recognitions will be that recognize the government grant is anchored. When the related cost anchored. Clear? So the general entry for this will be you will debit research and debit research and development expenses, and that will be 30,000, and credit will be government grant income 30,000. Clear? Now let's discuss another one. The second one, that is income grant for non-financial goal. Clear? So again, you have to match with the cost anchor. Clear? To achieve a goal, sorry. Clear? For example, this time we have a company Y, and this company Y receive government grant of, let's say, 40,000, and this grant aim to promoting job creation. Clear? Now the company have spent some money, and that is, let's say, 25,000 on hiring and training new employee during the reporting period. How you treat this? Let me show you as we sample. So here, recognize the government grant is income when cost related to achieving the non-financial goal, which in this case is job creation. So the double entry will be debit. You will imply zero expense, so imply expenses, and that amount is 25,000, and another credit will be your government grant income with the same amount. So this is the concept of matching with the cost anchor. Clear? Now let's move on. We have to talk about the presentation. Wait a minute, let me move on. Okay, here. The presentation of government grant that is related to income. Presentation of grant related to income. You may do just you present as a credit, and the statement of profit or loss, or you may deduct from related expenses. So when you do credit, so double entry will be like a relevant expense, and credit will be the government grant income. And if you deduct from related expenses, so it will be debit relevant expenses, and this will be net amount, and credit will be your government grant income. Clear? Now let me give you example, then we'll have better understanding. Okay, example related when you do a credit, we're going to be credit. So here is example. Let me write the example for you here. Let's say if a company receive a government grant for research expenses, so you will debit research expense, and credit will be government grant income. And if you deduct from the related expenses, let's say if a company receive grant for employee training cost, so debit will be employee training cost, and you know this will be net of grant. Clear? And credit will be your government grant income. Now, what are the key points that you must understand and you must know? That both methods, key point. The first one is both method result same, mean overall impact on profit will be nil. The second thing, companies choose the presentation method they find more appropriate. Clear? The third thing, the choice between methods may impact how expenses are compared across entities. So if we are thinking from the investor perspective, then method 1 enable a fair comparison, while the method 2, a deduction, may distort cost control and efficiency comparison. Clear? Now let's move on. We have to talk about the other grant, that is a grant related to the asset, and this is very important, very important. Now grant related to asset. Here again you have let's say for the purchase of non-current asset. It means that for the purchase of non-current asset. Now you have two methods. The first method is capitalization method, and the second one is deferred income method. Clear? Deferred income method. So in capitalization method, what you will do, you will deduct the grant. What you will do, you will deduct grant from asset cost. Okay, and then depreciate the net cost. While in deferred income method, the grant is treated as a deferred income, and releasing it to profit or loss over the asset life. So this we call it deferred income method. Clear? So the journal entry for the method 1, what is we call capitalization method, debit will be the non-current asset, and that will be the net of grant, and credit will be your deferred income, grant income. Clear? And for the second, the journal entry will be debit non-current asset, and that will be the full cost, and credit will be the deferred government grant income. Clear? Now let's we have to discuss the repayment of grant. So the first one, we have income base grant, and the treatment will be treatment. What you will do, you will debit the repayment to any liability for deferred income, and excess repayment charge to profit or loss. Let me give you an example here. For example, let's a company received a grant. Or let's say 10,000. for a project. And now they repay 5,000. So how you will treat this? You have to debit the repayment to any liability, and then the remaining will be charged to the profit or loss. So it's very simple. You have to debit government grant income, clear, and the cash which you will pay will be the 5,000. Clear? Now let's move on. We have to discuss another type of grant which you have to be repay. This is the second type, and that we call capital base grant, deducted from cost. The treatment will be increase the cost of the asset with the repayment. Recognize and charge the cumulative extra depreciation immediately. Example, let's say we have a company, and this company received grant of 20,000, deducted from the cost of the machine. Now they repay 8,000. So increase machinery cost by 8,000 and record extra depreciation. Clear? Now let's move on. We have another type. I think this is the last one, and then we will also do one question from the test to understanding question from the book. Okay. And this one, the last one, is the third. The capital base grant treated as a deferred income. So the treatment will be debit the repayment to any liability for deferred income, and excess repayment charge against profit. Example, a company received a grant of, let's say, 30,000 and treated as a deferred income. Now they repay, let's say, 12,000. So deferred will be deferred government grant income by how much? 12,000, and credit will be cash about 12,000. Okay. Now we have just completed the standard, and now let's move on to do one question from the book. This is the question that we have to do. The question is okay, let me read it. Here, discuss the possible accounting treatment of the above in the financial statement or clock for the year ending 31st December 2001. Okay. On 1st June 2001, Clark received a written confirmation from the local government agency that it would receive 1 million grant toward the purchase of a new office. This is the condition attached, and the grant become receivable. Okay, here the grant become receivable on that date. Clark transferred 10 million purchase prices of vendor. So on the 1st October 2001, Clark paid 10 million cash for new office. So mean the condition are made, and now they will have to receive the grant of 1 million. Now, which is estimated useful life is this one. By 1st December 2001, the building was ready for use. It means that it's now depreciable. When it's ready for use, then it's depreciable. And Clark received a government grant on this thing. Let's do this question. Very simple. The first thing is recognition. So when you will recognize recognition, you'll recognize when the condition met. You'll write it with condition compliance. And the second thing is reasonable assurance. Okay, now here the grant become receivable when on the date when the Clark transferred the 10 million purchase. So the Clark now on the 1st October 2001, Clark paid 10 million and cash for its office. So this the condition is also compliance. The Clark is compliant with the condition, and it is reasonable assurance that they have received. So what you will do, debit will be your cash and credit will be your grant with 1 million. Clear? Now you have two methods. One method I will write here, that is a capitalized method, whatever you want to use, capitalized method. And another one method is deferred income method. First we will do here. In capitalized method, building cost was 10 million, and you will deduct the grant, which is 1 million. So the net amount will be 9 million. Clear? Now depreciate this 9 million over the useful life of the asset. Clear? So 9 million divided by 50, and this is the years. Clear? Plus 1st December 2001, and we are reporting for this, so it will be 1 by 12. So the depreciation will be 0.05 million. That will be depreciation for this year, and this will be charged to profit or loss. Now the carrying value at 31st December 2001 will be 9 million less this amount, and you will get 8.985 million. This is by capitalization method. Now the second method is deferred income method. And deferred income method, you will do a debit when the grant received. Let me write here. When the grant received. So debit will be your cash or your bank, and credit will be deferred income with 1 Okay. Now you have purchased the asset, and for purchasing the asset, debit will be the building, office building, and the credit will be your cash or bank. With which amount? It will be the 10 million. Clear? Now releasing the government grant to the profit or loss. So here I will write releasing to profit or loss. So first debit will be the deferred income, and the credit will be your grant income. Okay, let's calculate here. The grant amount is 1 million. Total asset life is 50 years, and for 1 month, so it will be this just amortization, depreciation for the. So it will be 166. You will do it by yourself for calculation purpose. Now I'll put here 166 How about the depreciation of the asset of the building? That will be depreciation of building. So the amount is 10 million, 50, 1, 2, 12, and that will be 1. You will do it by yourself. This is the depreciation. So the carrying amount of asset, mean the building, will be, if you deduct this amount for 10 million, then you will get this. And the carrying amount of the liability So okay guys, we have completed, and you can do this by yourself from the book and you take it. If there's any problem, then you can comment. Thank you.